US GDP falls for the first time since 2022. US stocks slide around 0.5% and global oil prices fall another 3%. Lower core inflation in Australia lends support to the RBA cutting in May. New Zealand business confidence slumps on the tariff shock and the Bank of Thailand cuts. That's coming up in our 5 Things in 5 Minutes on Thursday, May the 1st. And then in our bonus deep dive interview, ANZ Economist Dhiraj Nim analyses foreign direct investment flows into and out of Asia, with some interesting findings on those outward flows.
On the positive side, it possibly means that some of the domestic players in these economies have become large enough, have global ambitions, and are looking to diversify markets.
But first, in 5 and 5 with ANZ, US GDP fell at an annual rate of 0.3% in the March quarter, its first fall since 2022 and worse than expected. But it was mostly about a last-minute surge of imports before Donald Trump's Liberation Day on April the 2nd. US stocks are down around 0.5% by 4 a.m. Sydney-Melbourne time, with oil prices falling more than 3% to $58 a barrel for West Texas Intermediate. ANZ's head of G3 Economics, Brian Martin, says the weakness was deeper in the data than just imports.
When you strip out imports, or what we call the impact of net trade on GDP, demand still slowed. Final sales to domestic purchasers were 2.3% in Q1, down from 3% in Q4. Now, there may well be some explanatory factors like severe weather effects, the LA wildfires that weighed on that data. But nonetheless, it does very much gel with some of the consumer confidence numbers that we've been seeing, which suggests that consumers are becoming more cautious in their spending habits.
By 4 a.m. Sydney-Melbourne time, the US 10-year yield was flat at 4.17%. The US dollar index was up 0.3%. The Aussie dollar, quite strong, up 0.4% at 64.13 US cents. The Kiwi flat at 59.45 US cents. Gold was down 0.5% at $3,316 an ounce, while those West Texas futures fell 3.4% to $58.37 a barrel. Number 2, Australia's headline CPI inflation rate remained steady at 2.4% in the first 3 months of the year. That was slightly higher than the market expectation, but in line with ANZ researchers' view. ANZ senior economist Adelaide Timbrell says key price increases in the quarter included those for education, health, and fruit and vegetables.
Of course, there was also the electricity price increase of 16.3% due to electricity rebate roll-offs, particularly in Queensland, as those $1,000 rebates ran out for a number of households. Without policy impacts, electricity would have risen 0.4% in the quarter. There were also a number of price falls in Q1. This included a lot of the discretionary categories. In fact, discretionary prices overall fell by 0.2% in the quarter, the first fall since March 2020.
Number 3. Adelaide says the trimmed mean measure of annual inflation was 2.9%, down from 3.3% in December, and that supports a rate cut on May the 20th by the Reserve Bank of Australia.
The trimmed mean inflation rate, the Reserve Bank's preferred measure, was up 0.7% over the quarter. The trimmed mean result could usually be considered as relatively neutral for the Reserve Bank's decision on monetary policy in May, but given the global backdrop and the recent encouraging inflation data, both in Q1 of this year but also in Q4 of last year, we consider a 25 basis point rate cut in May to be a near certainty.
Number 4. Headline business confidence in New Zealand fell 9 points in April after the US tariff announcements, according to ANZ's Business Outlook survey. ANZ New Zealand chief economist Sharon Zollner says responses worsened through the month.
Unfortunately, it didn't make good reading. While the past activity and employment measures weren't really affected, there was a big drop in business confidence, in expectations of own activity, in expectations about profit, credit availability. Investment intentions actually flipped negative. Even employment intentions were down a little bit. So now this late month sample is more volatile. It's noisier simply because it's smaller. But the consistency of the message does suggest there is something in this. Of course, we recently revised our forecast and took 0.5% out of our growth forecast for the next 12 months.
Number 5. The Bank of Thailand cut its policy rate 25 basis points to 1.75% yesterday, its third cut since October last year. ANZ economist Crystal Tan says the central bank noted how US trade policy and retaliatory measures were altering the global growth landscape.
Overall, the combination of a challenging growth backdrop and also weak inflation warrants more policy support. We think further policy rate cuts and targeted measures will be forthcoming from the BOT. We anticipate at least 2 more 25 basis point rate cuts this year, and also an expansion of the BOT's debt relief initiative to include more vulnerable groups.
Crystal tan there. Now, in our bonus deep dive interview, ANZ Economist Dhiraj Nim told me about his analysis of foreign direct investment flows in and out of Asia, outside of China and Japan, including a rise in outward foreign direct investment.
We looked at the net FDI trends in these Asia ex-China economies, the larger ones we left out, Japan, Hong Kong, and Singapore. But, the broader trend is of a slowdown. Of course, if you look at the net FDI numbers, they look pretty grim in 2024. Net FDI collectively in all these economies was about minus 0.1% of GDP. This was the weakest outcome since 2012. So that is, of course, a cause of concern. But if you look one level deeper, you find that not only the inward FDI, which usually happens in cycles, is experiencing a cyclical weakness, usually which reverses, but this time it's a bit sharper. At the same time, the outward FDI from the region, even from low per capita income economies such as India, has been structurally rising for a few years. So for anyone who thinks that the FDI dry up in the region is only because of geopolitical factors, possibly has to look at these trends which are brewing for quite a while.
So why is it that we're also seeing an impact on outward foreign direct investment?
Yes, so we see that many economies, including the North Asian economies of South Korea and Taiwan, at the same time, economies like India are experiencing a significant rise or a seemingly structural rise, as we have put it, in outward FDI. Now, there could be several reasons behind it. On the positive side, it possibly means that some of the domestic players in these economies have become large enough, have global ambitions, and are looking to diversify markets. But we also find that it is the financial services sector growth which possibly is propelling outward FDI from these economies. Financial services are growing at a much faster pace, given, of course, capital markets have deepened across the board, and a lot of these domestic players possibly have to do more outward FDI to service a global clientele much better. So services FDI is an important angle as far as outward FDI is concerned. But of course, when you look at data from economies like Taiwan, you see that, it could also have to do with the strategic play in a fragmented geopolitical order. It may have to do with acquisition of strategic resources abroad for you to maintain a global market share. At the same time, it could be a risk mitigation practice of not concentrating your production or markets in a way that potentially be a risk in a fragmented geopolitical order.
On the outward direct investment in financial services, you've focused in your note on India and Thailand. Could you give us a sense of what's going on underneath the surface there in India and Thailand with outward direct investment?
There's been a significant increase in the share of financial services and outward foreign direct investment from India and Thailand. Look, in India's case, it's even more interesting because we have more data to square it up. For example, Singapore is one of the largest destinations where this FDI is going. Makes sense. Singapore is a regional financial hub, which sort of validates our hypothesis that the growth in the financial sector, cross-border transactions, is possibly at the heart of it. We know that the interest in India, the interest of global capital in India, both from portfolio perspective and to some extent from direct investment perspective, has increased structurally over the last couple of decades, and Indian markets are much more deep now than they were before. We have things like index inclusion, etc., which has got a lot more people interested in Indian assets from a foreign investment point of view. So I think to service all of those clients, which is a rapidly growing number from a rapidly growing number of locations, Indian financial firms have to sort of establish base or set a presence in markets abroad so that they're able to service this clientele a lot better than they could have otherwise.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, May the 1st. Catch you tomorrow with the Bank of Japan's latest rate decision and analysis of how South Korea's exports fared during April. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.